everyone. We have an update from Harbour Group Corporation, trades on the New York Stock Exchange American under the symbol SKYH. It's an aviation infrastructure company developing the first nationwide network of home basing campuses for business aircraft. Please welcome its CFO, Francisco Gonzalez. Welcome back.
Thank you, Anna. And it's great to be back with you guys. You know, it was great a few months ago when we did this the first time. We obviously had a longer period of time there with our CEO in terms of going through our deck and our investor deck and so on. So we want to really use this time to do as much as Q&A as possible. But before we go there, I just wanted to maybe hit a couple of points here and then open it up for questions. I think I get asked a lot, what are the competitive advantages, or how is it that Sky Harbour's business model is going to result in excess returns for investors on a long-term basis and on a sustainable basis? And I think my answer has four pillars or four areas where on how we achieve that. The first one is one of the critical points of our business model is that we enter into these very long ground leases, 40, 50, 60 years with states, counties, or cities that own airports in major metropolitan areas in the U.S. And those ground leases for available land tends to be either the last land available or the last land available that the airport or the city or the county will basically apply to business aviation. So, and that's kind of like the first area of excess returns, because those ground leases are very attractive and very specialty real estate. There are no new airports being constructed in the U.S., so being able to access that land is very, very profitable into the future. So that's the first pillar. The second pillar of our areas of excess returns is our ability to, and the fact that we are a greenfield developer, meaning that we take that land, we construct and invest at cost, and are able to then create value for our shareholders. I will, in general terms, on average, for every dollar that we invest in a new campus of hangars, we probably could realize $3 and change if we were to flip that in a market value. So that pop, or that walk from cost to market value, accrues to our equity holders. And obviously we use leverage. So on an equity basis, the pop from greenfield to brownfield is about 6 or 7 times, depending on certain assumptions. So that's the second pillar of our way that we achieve excess returns over time. We are a greenfield developer. Third is economies of scale. We're national. We operate a lot of campuses. We now are using a prototype that we have designed and improved over time. We're vertically integrating into our construction of our own steel Lego sets, as I call them, steel pieces that build these hangars. And as we grow and we achieve additional scale, those economies of scale realize into lower construction costs and better margins. And then lastly, the fourth pillar of our competitive advantages has to do with our way we borrow and we leverage our equity through the use of private activity bonds in the municipal marketplace. These are long-dated, fixed-rate municipal taxes and bonds that we're able to then use and to pay for 70% of our total project cost. And when you combine our attractive NOI yields or cap rates, if you want to call it that way, with that type of leverage, that results in unit economics for our equity holders in the 30% area. So basically, those are the four pillars of our business model in terms of how we are put together or structured to deliver excess returns over time. So with that introduction, I want to basically pass it back to open up for questions with a little time that we have on it.
Great, thank you. Yes, are all of your campuses leased? When are the new campuses opening up?
Yes, thank you. So we are now operating in 4 airports, in Houston, in Nashville, in Miami, Opelika, and a facility that we lease from the San Jose airport in California. Those 4 are quote unquote fully leased. And I say quote unquote because, one of the interesting things about managing real estate in hangars at airports is that many times your tenants are not there, especially take a place like San Jose, where, it's a big hangar that we inherited. And so it's really shared space. So we get to rent some of these spaces in a way that, the plane, we rent the square footage of tail versus width on the wings, and that box. And then because we play like a little Tetris game of putting planes next to each other, you get to rent that box or some parts of that box twice. And in addition, we have a lot of apron. And when we have some people that we have, if available, rent, if there's space, they stay inside. If not, they stay outside. So we are able to achieve 120, 130% occupancy, which is something that intellectually makes no sense. But in the aviation space, you can do so. And so we're fully leased, but our revenues keep growing as we optimize that real estate. We're going to have 3 campuses opening now in Denver, Phoenix, and Dallas in Q1. And everybody who has been following us has seen the construction reports every month that we file and seeing the progress. And we're looking forward to opening those and leasing those during the Q1 and Q2.
And discuss the outcome of your recent equity capital raise. And are there any capital raises forthcoming?
Oh, yes. Thank you for that. We announced 6 weeks ago that we had accepted a offer to do a PIPE from a group of investors, many of them that were already investors of Sky Harbour, and some new names. And then we did that about 6 weeks ago. We announced $32 million. Then it was upsized before the first closing to 38. Now those investors have an option to subscribe for an additional 38. The interesting thing is that those options expire in 9 minutes today. So we are in the process of collecting the various notices that are coming in for people to subscribe to those options. So stay tuned for final announcement in the coming days. There's a process that we have to follow and so on. And then the closing of that second part of our PIPE is in December 20th. So we are cautiously optimistic that if we're fully subscribed or close to it, it will be another $38 million coming into the company on December 20th.
And discuss your recent announcement of an expected 9 additional ground leases to be signed at airports by year end of 2025.
Oh, yes. Thank you for that. So we're operating, as I said, in 4 campuses, but we have ground leases signed in another basically 10 campuses, so for a total of 14. And then in our last quarterly earnings webcast, we announced that we're going to expect to sign another 9 ground leases at airports between now and the end of 2025. These ground leases take time to negotiate and so forth. They have a long gestation. Some of them, we've been working on them for 3 years and so on. But we feel confident that they're coming because we have been working on them for so long, and some of them are now in their stage where with the final negotiations or final details, and we should be announcing some of these in the coming weeks.
And talk about how you plan to scale, all organically or through M&A.
Yes. Listen, we are on our core business is definitely organic growth. We have all these ground leases. You heard me talk about the walk from cost to market value. That is our core business. We have been shown a lot of existing hangar facilities, many of them which we have looked at but passed, given the cost. We're not in the business of paying someone for that creation of value. But every now and then, some existing facilities like San Jose, a good example, where we signed a ground lease, we inherited a facility, we invested $1 or $2 million, and we have been generating a lot of cash out of that facility. So every now and then, we will be opportunistic and very deliberate at looking at M&A because our core business is greenfield.
And when might the company turn cash flow positive?
Yes, thank you for that. We are continuing to aim for this time next year. Scale is the critical thing. As we scale, and these campuses that I mentioned that are opening up in the next in the next quarter, and as they get leased into the summer, that cash flow, we should make it that with our existing campuses and those 3 new campuses on a consolidated basis, we will break even on an operating cash flow basis. So we're looking forward to that, and that continues to be our guidance.
And Philip asks, which additional revenue stream do you think can be the largest over the next 2 to 3 years?
Well, our core business will continue being rental contracted revenues for our storage space of our campuses. You know, we rent hangar space, we rent office space. But we also make a margin on fuel. We're not an FBO, so we don't serve transit aircraft, but we do get a fee for fueling our tenants. And that, besides the rental revenue, that will be the second largest component. And then, as we have discussed in prior presentations and so on, we look to now have this captive tenant base and try to serve, provide be gatekeepers to other services that be provided in our campuses, from security, from detailing, people doing catering, people doing, insurance. I was talking to a bank earlier today who's like to provide financing if our tenants are looking to upsize their planes and so on. So all those type of things, we're not going to provide the service. We're just going to make it available on a preferred basis to our tenants and hopefully get a referral fee or a commission out of that.
Fantastic. Well, thank you so much for this update, and we'll see you in 2025.
Thank you, Anna. Thanks again for hosting us and for having us at your conference. We love always participating and look forward to seeing you guys again next year. Thank you.
Absolutely. All right, everyone, thank you for a great day. This completes day 1. We'll see you back here tomorrow morning at 9 a.m. Eastern for day 2 of our virtual investor conference. Thanks for watching.